Imagine a city where, like, tens of thousands of highly paid tech workers are moving in every single year. I mean, demand is just completely off the charts.
Oh, yeah. Totally unprecedented.
Right. The population is booming, jobs are literally everywhere, and yet rents are suddenly plummeting by 20%.
Which is wild.
It is. And landlords are out there begging people to sign leases, handing out free months of rent, gift cards, you name it. It completely defies everything we think we know about economics.
Yeah.
But in Austin, Texas, that is exactly what happened.
It really does challenge that old assumption that real estate only operates on this gentle upward slope.
Mm-hmm.
You know, we're taught that once a market reaches a certain tier of pricing, it never really goes back. It just plateaus.
Yeah, that it only ever goes up.
Exactly. But Austin proved that gravity still exists in housing.
And we're going to figure out how they manipulated that gravity. So today is May 21, 2026, and we're looking at this massive stack of research. It's a comprehensive strategic analysis of the Austin residential rental market from 2021, stretching all the way to a forecast for 2031.
It's a lot of data.
It really is. Okay, let's unpack this. Because whether you are actively hunting for an apartment right now, or maybe you're looking to invest your life savings into a rental property, or even if you're just insanely curious about how wild economic swings actually happen on the ground, this deep dive is basically a masterclass in real estate dynamics.
It really is the story of the ultimate pandemic boomtown. I mean, it's a city that transformed from a somewhat affordable music and tech hub into one of the most expensive places to live in the entire country.
Oh, absolutely.
And then through this just unprecedented wave of new construction, they essentially engineered their own price crash.
But to understand the highly unusual, very renter-friendly market we're sitting in today, here in mid-2026, we can't just look at the current numbers. We have to rewind the tape a bit.
Right, you have to look at the historic boom that set the trap for developers in the first place.
Exactly. So let's jump back to 2021.
That's really where the frenzy begins. And we have to look at the macroeconomic drivers of that moment.
Right.
In 2021, the pandemic was actively reshaping how Americans worked.
Right. Remote work was suddenly everywhere.
Yeah, remote work became the norm, interest rates were sitting near zero, and you had this massive cohort of tech workers on the coasts looking around their tiny, incredibly expensive apartments.
Realizing they could just leave.
Exactly, realizing they could take their six-figure salaries anywhere they wanted.
So they looked at Austin. I mean, no state income tax, warmer weather, a really great cultural scene. And the migration numbers from our sources are just staggering. By late 2021, this sudden influx pushed the median rent in Austin up to about $546.
Which was a massive jump.
Huge. To give you some context on that, it was 15% above the national average at the time. So Austin wasn't just catching up to the rest of the country, it was blown right past it.
And the fundamental problem there was the city simply didn't have the housing inventory to absorb a migration wave of that magnitude.
You just didn't have the beds.
No, they didn't. Vacancies plummeted to historic lows, sitting somewhere between 4 and 6%.
Wow.
And in real estate terms, a vacancy rate that low means the city is functionally full. There is basically zero slack in the system.
So if an apartment opened up, there was just a line of people ready to bid over the asking price.
Oh, absolutely. Bidding wars for rentals became completely normal.
And 2022 was the absolute peak of this madness. We're talking 10 to 15% year-over-year rent growth in a lot of quarters. Landlords were just naming their price, and panicked renters were paying it.
Especially for those Class A luxury units.
Right, the really nice ones.
Yeah, those are the brand new, highly amenitized buildings with the rooftop pools, the massive fitness centers, the built-in co-working spaces.
The ones that feel like resorts.
Exactly. Those properties saw the wildest gains because that's exactly what this incoming demographic of remote tech workers demanded. I mean, they were willing to pay a premium for that lifestyle.
If we connect this to the bigger picture, this period didn't just raise rents. It fundamentally transformed Austin's identity.
It really did.
It erased the city's status as this relatively affordable Sun-Belt haven and officially turned it into a high-cost tech hub. The entire economic DNA of the metro area was basically altered in about 24 months.
And that rapid alteration sent a massive flashing green light to real estate developers all over the country.
They saw the dollar signs?
They did. They looked at those 2021 rent growth numbers. They saw all the cheap debt available from banks, and their spreadsheets just told them to build as much as humanly possible, as fast as possible.
Which brings me to an analogy I've been thinking about. The way developers reacted reminds me of ordering food at a restaurant with a severely backlogged kitchen.
Oh, I like this.
So it's 2021, and you are starving. You want food right now.
Yeah.
So you panic, and you order 10 different appetizers.
Because you're starving, right?
Right. But the kitchen is incredibly slow. It actually takes them 3 years to cook the food. So by the time all 10 plates arrive at your table in 2024, your hunger is completely gone. You've already eaten a whole basket of bread, and you're full. But the kitchen just keeps bringing plates out anyway.
That captures the structural lag perfectly. The fundamental challenge of real estate is that you can't build an apartment complex overnight.
Right. It's not a software update.
Exactly. It takes years to secure permits, clear the land, pour the concrete, frame the building. So the panic decisions developers made during the frenzy of 2021 and 2022 directly resulted in a historic wave of supply hitting the market years later.
Long after the frantic demand had started to normalize.
Precisely.
And historic wave honestly feels like a dramatic understatement when you dig into the data here.
Mm-hmm.
Over a multi-year period, developers added roughly 120,000 new units to the Austin housing stock.
It's an astronomical number.
Let me just repeat that for you because it's hard to even conceptualize. 120,000 units. In 2024 alone, they delivered between 30,000 and 36,000 apartment units.
And when you dump that much inventory onto a market all at once, you trigger a massive supply shock.
The leverage instantly flips.
It flips from the landlord to the tenant overnight. And the vacancy rates reflect that shock perfectly. We went from that super tight 4 to 6% vacancy rate in the boom years all the way up to peaks of 14 to 15.8% in 2024 and early 2025.
Almost 16% empty.
Yeah, those were among the highest vacancy rates of any major metro in the United States.
So suddenly, you have these brand new luxury buildings just sitting half empty.
Mm-hmm.
And prices responded exactly how the laws of economics dictate. The bottom just fell out.
It really did.
Rents dropped 15 to 20% from their 2022 peaks. And if you adjust for inflation, the real value of those rents actually fell a staggering 19% between 2021 and 2025. Landlords went from hosting bidding wars to full-on panic mode.
The concessions were incredible to watch, honestly. Property managers were waiving application fees, offering free parking, and handing out 1 or even 2 full months of free rent just to get a signature on a lease.
Just desperate for anyone to move in.
Very desperate. And what's crucial to understand is how this supply shock cascades down through the entire market. It doesn't just hurt the luxury developers.
Right, because if a high-end Class A building is suddenly offering 2 months free, it basically makes their rent the exact same price as an older, less glamorous building down the street.
Exactly the mechanism I'm talking about. We call it the waterfall effect.
The waterfall effect, okay.
Yeah. When the Class A buildings drop their effective rents to survive, they steal tenants from the middle-tier Class B buildings.
Makes sense.
So to stop the bleeding, the Class B buildings have to slash their rents. That forces the older, most affordable Class C units to lower their rents too. The whole pricing structure compresses downward. Even Class C properties saw steep declines of around 11%.
Here's where it gets really interesting, though. Because if you just read the headlines over the last couple of years, the narrative was that the Austin bubble burst because everyone left.
Oh, the mass exodus narrative.
Right. You'd see articles claiming the tech boom ended, remote work got canceled, and the city just emptied out. But looking at our research stack, that's just a myth, isn't it?
It is a complete myth. It's a fundamental misreading of what was actually happening on the ground. The metric we need to look at to disprove that myth is called absorption.
Right. And for those who aren't steeped in real estate jargon, absorption is just the net number of units that get leased up over a specific time period.
Exactly.
It's a direct measurement of actual demand. You're basically measuring bodies moving into beds.
And the absorption in Austin remained exceptionally strong the entire time. I mean, we're looking at quarters where 5,000 to 16,000 units were being absorbed.
Wow.
Yeah, by 2025, annual absorption actually exceeded 20,000 units. To put that in plain English, 20,000 more apartments were rented than vacated.
So people were absolutely still arriving. The demand was still there.
What's fascinating here is that distinguishes Austin from a city experiencing a true economic collapse.
How so?
Well, in a collapse, jobs disappear and people flee. That didn't happen here. The tech jobs were largely still there. The major university was still churning out graduates who wanted to stay, and corporations were still relocating.
Right, the engine was still running.
Exactly. It wasn't a demand crisis at all. It was purely a crisis of overzealous developers. The sheer volume of concrete they poured vastly outpaced what was actually a very healthy, very robust rate of immigration.
So if landlords are bleeding money on empty units, and there are still tens of thousands of apartments fighting for tenants.
Mhm.
What does the market actually look like for someone living there today? Because demand stayed strong while construction temporarily overshot the moon, we've landed in a highly unique sweet spot as of mid-2026.
We really have. And the defining characteristic of the current reality is divergence.
Divergence.
Yeah, the market has fractured. Not every type of property, and certainly not every neighborhood, is behaving the same way anymore.
Let's avoid just reading a spreadsheet here, but we do need to look at the gap in the numbers because it's wild. As of May 2026, the overall blended median rent for Greater Austin is down about 5.6% year over year.
Right.
But let's look at the delta between property types.
Yeah.
If you were in a standard one-bedroom apartment right now, you're paying around $1,400. Or, a studio is about $1,300. A two-bedroom is $1,800. And a three-bedroom is around $2,400.
Mm-hmm.
But if you want to rent a single-family home, like a whole house with a yard, that median rent sits at over $2,200. That is a massive premium just to get out of an apartment building.
It is, and that premium tells us a story about demographics and psychology.
How do you mean?
Well, think about the people who moved to Austin during the frenzy. A 25-year-old tech worker who arrived in 2021 is now 30 years old in 2026.
Right, they've grown up a bit.
Exactly. Their lifestyle has fundamentally changed. Maybe they have a long-term partner now. They probably adopted a dog during the pandemic. Maybe they're thinking about starting a family. They are aging out of the desire to share a crowded elevator or listen to a noisy upstairs neighbor.
They want a backyard. They want a private garage for their car.
And they are clearly willing to pay top dollar for that space and privacy. Single-family homes offer a lifestyle that an apartment block simply can't compete with for that aging demographic.
That makes total sense.
And meanwhile, the multifamily properties bore the absolute brunt of the oversupply. Remember, developers didn't build 120,000 single-family rental homes. They built 120,000 apartment units. So the apartment sector is heavily saturated while houses are scarce.
The days on market data proves that scarcity beautifully, too. If you're a landlord trying to rent out an apartment right now, our sources show that unit is sitting empty for an average of 113 days.
Which is painful.
That's nearly 4 months of zero income. But if you list a single-family rental home, it gets snapped up in just about 38 days.
The divergence is also highly geographical, by the way.
Oh, really?
Yeah. The data shows that the downtown core has been surprisingly resilient. Rent drops there weren't nearly as catastrophic. But when you look at the northern suburbs, places like Pflugerville and Round Rock, they saw much deeper corrections.
Why is that? What makes a suburb like Round Rock more vulnerable to a crash than downtown?
It comes down to the barrier to entry for developers. Downtown Austin is constrained, land is incredibly expensive, zoning is tight, and building a high-rise is technically complex.
Right, you can't just throw up a skyscraper in a weekend.
Exactly. But out in the suburbs, land is cheap and plentiful. It's relatively easy to buy a massive plot off the highway and throw up a sprawling 400-unit complex. The problem is, when 5 different developers do that on the exact same highway interchange in the same month, the bottom falls out of the local pricing.
So bringing this directly back to you, the listener, if you are a tenant in Austin right now, especially if you're looking at apartments in those suburbs, you have massive negotiating power.
Oh, absolutely.
Vacancies are improving, but they still sit between 11 and 13.8%. Landlords are highly motivated because, as we said, an empty unit for 113 days is devastating to their bottom line.
It destroys their yield.
So you can negotiate on the base rent, you can ask for waived pet fees, you can demand better lease terms. It is your market.
But, enjoy it while it lasts, because as with all things in real estate, the pendulum never stops swinging. The conditions that created this renter's paradise are already starting to vanish.
Which leads us to the big question. What happens to the city when the cranes disappear? Because just as that massive building wave of 2022 caused the renter's market of today, a sudden screeching halt in new construction is setting us up for the next 5 years.
Yeah, the pipeline of new construction has virtually collapsed.
Completely dried up.
Think about it from the developer's perspective. When rents dropped by nearly 20%, the projected revenues just evaporated. And at the exact same time, interest rates on construction loans remained elevated. The math simply didn't work anymore.
The bank said no.
Exactly. Banks looked at the empty units in Austin and stopped financing new projects.
So developers just slammed on the brakes.
Yeah.
And we see that in the projections for 2026. The new deliveries are sharply lower, We're talking only about 4,700 to 10,000 units expected to come online this year.
That's a huge drop.
It is a massive, sudden drop from the 36,000 we saw in 2024. In fact, our sources note this makes 2026 the lowest year for new deliveries since 2012.
And because that pipeline is emptying out, the forecast from 2026 to 2031 maps out a very clear three-phase recovery.
Okay, let's hear the phases.
We're currently in phase one, which is the stabilization year of 2026. Rents are staying relatively flat, maybe eking out a 0 to 3% gain as the last of that oversupply gets absorbed.
Then we hit the recovery phase in 2027 and 2028. Because absorption remains strong and nobody is building new apartments, the market tightens back up. Rent growth is expected to accelerate to 2 to 4% annually, and those sweet concessions like free rent will just quietly disappear.
Which brings us to phase three, normalized growth from 2029 to 2031. The forecast predicts annual rent increases of 3 to 5%, leading to a cumulative rent growth of 12 to 20% over the next 5 years.
So what does this all mean for the people with money on the sidelines? I'm reading the strategic analysis here, and it says this shrinking pipeline is creating a golden window for investors.
Right.
It specifically points out that cap rates have stabilized in the 5.5 to 6.5% range, making it ideal for value-add buys. But I'm going to need you to pause right there.
Sure.
For the non-investors listening, and frankly, for me, what exactly is a cap rate? And why is that 6% number the magic signal that it's safe to buy again?
It's a great question. Cap rate is short for capitalization rate. It's essentially the annual rate of return you can expect on a real estate investment if you bought it entirely in cash.
Okay.
So if you buy an apartment building for $1 million and it generates $60,000 a year in profit after all your expenses, that's a 6% cap rate. It's your baseline yield.
Okay, so a higher cap rate basically means a better return on your money.
Exactly. During the 2021 frenzy, prices were so insanely high that investors were accepting cap rates of 3% or lower just to win a bidding war.
Which sounds terrible.
It was incredibly risky. But now that property values have dropped during this correction, those cap rates have mathematically floated back up to around 6%. That tells institutional money that the bleeding has stopped. Prices are rational again.
And a value-add buy. What's that?
That's industry shorthand for buying an older, slightly run-down property, usually a Class B or C building, putting a little money into renovations, and then raising the rents.
Got it. So institutional investors are looking at this 2026 window. They're seeing rational prices and knowing that new supply is about to dry up completely by 2027. It sounds like a guaranteed bet to swoop in and buy up single-family rental portfolios before prices inevitably spike again.
This raises an important question, though. While the data strongly suggests this is an excellent acquisition window, there are no guaranteed bets in real estate.
Right up.
It requires serious risk assessment.
Wait, I actually had to challenge this whole normalized forecast idea anyway.
Go for it.
The experts are sitting here telling us that by 2029, we'll see steady, predictable 3 to 5% growth. But didn't these exact same experts think that 2021 boom was sustainable too? I mean, why should a renter or an investor trust these clean upward trend lines now when the industry got it so massively wrong just 3 years ago?
That's incredibly fair pushback. Projections are just educated guesses based on current math, and there are massive macroeconomic risks that could blow these forecasts completely out of the water.
Like what?
Well, what if there is a broader national recession? Austin is resilient, but it isn't immune. What if the tech sector, which has already been cautious since the layoffs a few years ago, decides to pull back further on their footprint in the city?
Right.
If job growth slows down, that robust absorption rate we praised earlier just drops to 0.
And what about the developers? I mean, if rents jump 4% in 2027 and it looks profitable again, won't they just get greedy and start pouring concrete again, triggering another wave of overbuilding?
It's entirely possible. Real estate is cyclical, and human behavior tends to repeat itself.
To put it mildly.
Yeah. But looking at the structural data over the full decade, the core takeaway is actually quite optimistic. Austin took its medicine. It successfully worked through a historic, painful supply correction.
The worst of the declines are definitively behind us. The unpredictable frenzy won't return, which is a good thing for the sanity of everyone involved. But the continuous job growth and the overarching national housing shortage, provide a very strong tailwind.
Exactly. And knowledge of these mechanics isn't just academic. Understanding the lag between construction and demand has a literal, tangible impact on your monthly budget and your long-term wealth.
Exactly. If you're a renter going to sign a lease tomorrow, you now know exactly why the landlord is sweating, and you know to push hard for that month of free rent while the window is still open. And if you're an investor, you understand why a suburban apartment complex in Round Rock is a riskier bet right now than a single-family home with a yard. You aren't just reacting to headlines, you actually understand the gears turning beneath the market.
It's all about navigating the cycles rather than being crushed by them.
Before we sign off, we want to list every source we used for today's deep dive. Our insights were drawn from data provided by Pew Research, Realtor.com, Zillow, Dorsted, Colliers, Matthews Real Estate, and the Austin Apartment Association.
It's really critical to ground these volatile market shifts in rigorous data from a wide variety of perspectives.
Absolutely. Now, I want to leave you with a final thought to chew on. We just spent this entire time unpacking how a massive, somewhat reckless building boom was able to drive Austin rents down by nearly 20% in just a few years. It completely changed the affordability landscape for everyday renters. So if we have empirical, indisputable proof that flooding a market with aggressive supply actively destroys the cost of housing, why aren't we applying this exact same aggressive playbook to solve the paralyzing housing affordability crises in places like New York, Los Angeles, or Boston?
It's a profound question. It forces us to ask whether our housing crises are really about a lack of space, or if they're about zoning, politics, and who ultimately controls the physical shape of our cities.
It really makes you wonder. We love to complain about how expensive the cover charge is at the nightclub, but maybe the solution has always just been to build a bigger club. Keep questioning the numbers, and we'll see you next time.